Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Before we get into today's episode, I wanted to remind you that Trish Regan is now a part of the Stansberry family. So go check out her show, American Consequences with Trish Regan. The link will be in the description of this episode. As for today, we've got a great one for you. We'll talk with Jim Masturzo. He's the asset allocation guy at Research Affiliates. You've probably heard me mention Research Affiliates many times on the program. They put out a lot of great research, which is absolutely free on their website. And we'll talk to Jim about what he does. And I'll, of course, ask him my usual question of what is the one thing he wants to tell you before he leaves us today. He gave a great answer to that question. I'm just going to tell you. This week in the mailbag, questions and comments about election fraud, Bitcoin, commodities, and more. In my opening rant this week, I'll comment on election fraud, negative yielding bonds versus gold and Bitcoin, and I'll share a little of my colleague Mike DiBiase's work on zombie companies. And I'll finish up with our inaugural quote of the week from my old friend Chris Mayer. That and more right now on the Stansberry Investor Hour. First topic this week is election fraud. What do I think? I don't know, but I don't have to know. All I have to do is think about it a little bit. Now, look, if it turns out that there's an election fraud, this thing will probably, the story won't go away. It'll churn in the news for, I don't know, weeks, couple of months, who knows? I have no idea. But the longer it goes on, I think the worse it is for stocks and the better for maybe for the traditional market hedges, gold, silver, Bitcoin, maybe treasury bonds. So, that's really all I have to say about that. I don't have a view one way or the other. I don't know if there was fraud. I don't know if it looks like there was fraud. Although I did see one guy on Twitter pointed to an article in the New York Times, and the New York Times reporter called around. He said he called all the state heads of election boards or whatever, the head guy in each state, right, for elections, and asked them. And they said, well, no, there was no fraud here, which is ridiculous, of course. It's a funny thing. When I go to the barber and say, do I need a haircut? He always says yes. Isn't that crazy? So that's a ridiculous article, and it's a ridiculous, it doesn't constitute real research. So we don't know. And anybody who says they know, I go, oh, God, you got to be kidding me. Come on, you're an idiot. You don't know. You don't know anything. You don't know anything about climate. You don't know anything about election fraud. I don't believe anything anybody tells me that they know anymore. All right, so that's that. If election fraud plays out and the narrative doesn't go away and then it gets real substance to it, I think it'll be bad for the stock market. Now, let's talk about gold and silver and Bitcoin a little bit. And what we're really talking about here is negative yielding bonds. Why? Well, because when bonds yield nothing, when the safe havens of the world, the sovereign bonds of Europe and Japan, mostly, they're the big negative yielders. When they yield nothing, well then, why not just hold gold? Gold yields nothing as well and might hold its value a lot better than the yen and the euro if they just keep printing them up forever, which we know they will. So, in other words, negative yielding bonds are kind of traditionally good for gold, right? Except lately. Okay, so Bloomberg, Financial Times, maybe another. I think there might have been another source, I can't remember. But those two had articles recently pointing out that last week, the amount of negative yielding bonds in the world hit a new all-time high. It was like 17.05 trillion, eclipsing the August 2019 high of 17.04 trillion. Of negative yielding debt in the world. Like I said, it's mostly Japan sovereign debt and European sovereign debt. So here we are. We've got this new high in negative yielding bonds. But you know something? When I look at the action since about August, September in gold, Bitcoin, and silver, what do I see? Well, the negative yielding bonds are soaring out of sight, right? That number is going up and up and up. Gold and silver are kind of retreating into like a little bounce in early September, kind of going sideways. And what else is happening? Bitcoin, since that time, is soaring. So this is one of the risks of that's in, I believe, is present in holding gold and silver versus Bitcoin. I think Bitcoin is outperforming here because it's coming to be recognized more widely as a legit store of value. Now, do I think this trend just, this is it, it's going to take off forever and gold and silver are going to be crap forever and Bitcoin's going to be great? No, I think this goes in waves. And I'm not selling my gold and silver, but I haven't bought any more this year. I think I bought some in April, and that's the last physical gold and silver I bought. But Bitcoin, I can't count the number of transactions I've executed just buying more Bitcoin here and there. Like 3 or 4 transactions in the past 2 weeks, just to give you a random sample. So I really like Bitcoin, as you know, and I think it's much earlier days than gold and silver, right? Bitcoin was invented in 2009. Gold and silver have been around for 6,000 years, right? So we know about gold and silver, but Bitcoin has this newness. And those of us who kind of believe it in early, I think, might wind up having an enormous advantage over people who don't figure it out until later. We could be up 10, 20x by the time, well, by definition, right? We will be up 10, 20, 50x by the time the rest of the world, if it does gain, rest of the world kind of acknowledgement, figure it out. That's what I have to say about that. I'm not going to fret about it too much because it's a very short-term phenomenon. We're talking about since September here, okay? So don't freak out. Don't sell I don't recommend selling your gold. You do what you want, right? It's your money. But I'm certainly not doing that. I'm aware of this. I'm aware of the competition as a store of value between gold, silver, and Bitcoin. And that's really all I wanted to say about that. All right, so having said that, my colleague Mike DiBiase at Stansberry, he's the editor of our Stansberry's Credit Opportunities, our high yield bond letter. And he does a great job. And our publisher likes to say that Mike has a lot of bandwidth because Mike is really smart. If you give him a project, he's like the Excel stats wizard. He can turn it around instantly. I've always been very impressed with him. And he wrote a piece recently pointing out something that I believe I mentioned it once or twice. It's the zombie apocalypse among U.S. companies, okay? And it's just the simple fact that, as Mike says, a record 18% of U.S. companies are zombies today, according to the Bank of International Settlements. A zombie company is one that basically can't service its debts. It needs some kind of bailout, even if the bailout is just, some crazy bank or investor lending them more money. And this is higher, Mike points out, than the 14% peak before the financial crisis and the previous peak of 17% all time set back in 2001. Remember, in the wake of that, there was a huge rout in high yield debt and a huge opportunity to make a ton of money at the bottom. But yeah, this 18%, nearly 1 in 5 U.S. companies can't afford their debt load. So and of course, we are still in this, COVID lockdown-induced recession. And as this drags on, of course, more and more companies are going to have to default and declare bankruptcy. And Mike says so far this year, 124 U.S. companies have defaulted on their debt, including like 57 in the second quarter. Highest number of quarterly defaults since 77 companies defaulted in the second quarter of 2009. So the numbers are getting up there. And what we're setting up for here is, and Mike watches this because he knows on the other side of this, like he will be shooting fish in a barrel once if the default rates really spike up and we get all the really people, all these zombies get wiped out, basically, a couple thousand companies maybe. Not all of the debt is completely worthless, right? So a guy like Mike can pick through there and find phenomenal deals where you can buy a bond and make 5 or 6 times your money, right? It's amazing. When these things happen, the returns can be amazing. So I just wanted to point this out, like, before it all happens, and I'll do my best to revisit this and check back in with Mike. Maybe we'll get him on the program if we do get a nice big washout in the high yield debt and see some opportunity popping up. I want to put this on the radar screen, and I think that's all I have to say about that right now. All right. I'm going to do something right now that I plan to do it every week, and I'm just calling it my quote of the week. Just something that kind of grabbed me as particularly wise and particularly meaningful to me, which I thought I should pass on to you. And for the first one, I was careful about the selection. First of all, it's by my old friend Chris Mayer, who Chris and I are like the two diehard value investors, although we do have Brian Beach now at Stansberry. So there's 3 of us, all across the whole, Stansberry's whole parent company who are still out there. And it's funny, Chris and I have had this thing over the years where if we disagreed about a company and one of us owned it, maybe they did pretty well. But if we both agreed about a stock, it did terribly. And that happened 3 or 4 times. I'm not kidding. So, after a while, we started asking each other, hey, do you like this? Because if the answer was yes, it was like, oh, crap, here we go. So here's my quote of the week, and this kind of applies to me too. These could be my very own words, but they're Chris Mayer's words at woodlockhousefamilycapital.com. He says, as I get older, and I hope wiser as an investor, I find myself giving much greater weight to fuzzier concepts such as culture and governance and competitive positioning. The numbers ultimately have to make sense, but these qualitative factors underpin my investment decisions in a way they didn't when I was younger. Experience, that is, being burned when these factors were absent, have taught me to pay attention, end quote. Man, I can't tell you how much this has affected me as well. One day you just realize that companies are run by human beings, and human beings don't do things because of numbers. Not everything, anyway. And most of what they do, most of what human beings do is in response to some deeper question of why to do this thing. So at some point, I just realized, all these numbers I'm looking at in the financial statements, the 10Ks and the 10Qs and all that, they're history. And they are in the past, and they're not necessarily going to be like that in the future. So if you think that, the past 10 years of some companies' financials is a good representation of what they can continue to do, you had better know those qualitative factors. Totally in agreement with Chris on this. I think it's a very wise quote, and I hope it's valuable to you too. All right. Let's talk with Jim Masturzo. Let's do that right now. I've known Dave Lashmet for over 20 years, and he is on fire right now. On average, his closed picks this year have returned 187%, almost triple your money. That's based on all his closed positions, winners and losers, no cherry picking. Today, he is pounding the table on a time-sensitive $13 stock he thinks is set to explode. It's all based on a potential FDA announcement that Dave believes is coming in a matter of weeks. This is an opportunity you don't want to miss. You can hear Dave's take along with all his evidence on the stock over at investorhourtech.com. Check it out. Today's guest is Jim Masturzo. Jim leads Research Affiliates' asset allocation research and trading team. In this role, he oversees both the quantitative modeling used to generate the firm's tactically managed multi-asset portfolios, and the daily trading efforts related to the firm's portfolio of asset allocation products. Jim sounds busy to me. In addition, Jim is responsible for driving the data and analytics available within the firm's public asset allocation resources, supporting the clear and accurate communication of research affiliates' strategic views, and promoting the use of the Asset Allocation Interactive website. Prior to joining Research Affiliates, Jim worked at Bloomberg, specializing in portfolio analytics. In this role, Jim advised portfolio managers on best practices related to performance measurement, attribution, and risk analytics for equity and fixed income portfolios. Jim has a BS in electrical engineering from Cornell University and an MBA from the Duke University Fuqua School of Business. He holds the Chartered Financial Analyst designation and is a member of the CFA Institute and CFA Society Orange County. He sounds even busier than I thought. Jim Masturzo, welcome to the program.
Thank you, and thank you for that kind introduction. My life has never sounded so interesting.
It does sound interesting, and it all sounds very technical. How do you sum all that up? You're the asset allocation guy. That's what I'm getting from all this.
That's right. It's interesting. You said it all sounds very technical, and it is. Although I don't necessarily think of myself as an uber technical guy. I really try to, abstract away from a lot of the details that a lot of quants are really good at and probably better than me, and really start to think about the bigger pictures and how do some of these things impact markets. I tell my team, and I have a team of very smart quants who do a lot of very interesting things, that numbers on a spreadsheet aren't numbers on a spreadsheet. Those are actual. Eventually will be translated into actual dollars from someone's portfolio, and we should be thinking about them in that way.
I see. So the electrical engineer from Cornell who does quantitative stuff doesn't think of himself as a technical guy. That's cool. And it's good for your clients probably. But let me go back a little bit. With anybody who's in your business, I'm so curious about this with everyone I talk to who's in your business. When in your life, at what age were you, 5 years old or 15 or 35, when you decided that this was your calling, this was your career path?
That's an interesting question. My career, and, you highlighted a lot of it, but there are a few other, spots in the middle, has been a little bit, let's just say non-traditional, I guess. I did study electrical engineering, but then decided very quickly, actually, to answer your question, at about 5 years old, I decided I wanted to be an electrical engineer. And then I started to study electrical engineering and figured out pretty quickly I didn't want to be an electrical engineer. And this was late 90s, early 2000s. And so I did what everyone else did at that time. I went and I was a management consultant for a couple of years, basically because I said, this thing I thought I wanted to do for, 15 years, 20 years, I don't really want to do. So let me go, try a bunch of things. And then consulting seemed like a good way to get some experience in different fields. And that's when I really started to think more about finance, started to learn about the industry. As a consultant, I was basically a software developer. So writing a lot of code. We were writing Java code at that time, building systems. Most of the projects I worked on at that time were for the Wall Street Bank. So I learned a little bit about the industry, said, wow, this is really interesting. And then did the MBA and kind of started from there.
Aha. The MBA kind of set you off and the consulting gigs. That's cool. So tell me about how did you come to Research Affiliates, which is a firm that I must mention Research Affiliates like once every, I'm going to say 3 or 4 podcasts, because you guys have all this research available for free on the website, and I can go read it. And I've seen Rob Arnott at Grants and on YouTube and places as well. How did you come to Research Affiliates? It's it looks like a really cool firm to work for.
Yeah, it is. And again, sort of an interesting story. So like many, I guess, of my classmates at the time, I have the distinction of getting out of my undergraduate degree in '99. So just a hair before the tech bubble blew up. And then I finished the MBA in '07, again, just a hair before the global financial crisis hit. Um, and so kind of interesting times, and getting through those times, and the financial crisis being maybe more relevant. Again, I was doing some consulting gigs at the time, just trying to, keep myself active, stay employed, which was more than I could say for a lot of my classmates, unfortunately. But ended up at Bloomberg, and while I was at Bloomberg, and that was when I made the switch to the West Coast, started to learn about this little firm called Research Affiliates here in Orange County. Read a lot of Rob's stuff. I was familiar with Rob. Actually, didn't even know at that time that Rob had a firm. I thought Rob was just a guy on his own who was writing. But started to learn about the firm. Started to meet some people here, and then ended up coming here in I guess it was 2013, because they said, hey, we have this idea that we'd really like to build a web app to display our long-term capital market expectations, which was our asset allocation interactive tool that you mentioned earlier. And I was like, well, that's kind of interesting. It sort of blends some of the things I'd done in the past. It's like I said earlier, I started in software development, so I kind of understand how that works, and knew something about long-term capital market expectations. So I said, hey, let's just do that. And at the time, it was kind of like, look, come, let's do this, and then after that, we'll figure out what's next. So I did that. The first year or so I was here, that's what I worked on, and then transitioned into full-time into the asset allocation group, which sort of was a natural transition at that point. And the rest is history, I guess.
It is history. It's some interesting history, it sounds like. Maybe you can't speak to this, but I'm going to ask anyway. I notice very often when I see Rob speaking, the conversation turns to value a lot. And I'm curious about that. Just, he's the head guy there, and he talks about value a lot. Like, how value oriented is Research Affiliates, I guess, is the overall question.
Rob, as you mentioned, is a value investor at his core. Rob believes in value, as do many people. Rob is at his core a value investor, and so is the firm. And I like to think that there are value shops out there and growth shops out there, but you tend to attract people who don't necessarily 100% agree with everything you do, and we're not looking for that, because we don't want groupthink and other things. But you tend to attract folks who believe in value, at least to some extent. So most of our products, if you look across, especially our equity products, tend to be very value based. In asset allocation, it's a little bit different, even though value is a big part of what we do, because valuations in different asset classes are very different, and being able to look across asset classes and try to compare things can be tricky at times. So in credit markets, we're talking about spreads, and in equities, we're talking about PE multiples or some other multiple, and in currencies, what's the fair value of a currency over time, or a commodity. And so as we kind of look at these things, we're also forced to look at other signals. We have momentum signals and carry signals, and a number of other things that bleed into my area.
Right. Hey, speaking of signals, I hope you don't mind me jumping around a little bit like this, but it just reminded me of a piece that you and I think one or two other folks wrote in July 2018. And you were saying that you were looking at a couple of different metrics and saying, this all points to a correction. And indeed, we did have a bit of a correction in late 2018, did we not? How did you guys predict that, or forecast or suspect that it was upon us?
Yeah, so we did have a correction, a pretty violent correction there in Q4 of 2018. What we do is really look at data. So, we don't try to, we're not fundamentalists. We didn't say necessarily that, the story for the correction in 2018 was, Fed tightening and, quantitative tightening, raising of interest rates, that sort of thing, which is a very plausible explanation ex post. But what we try to do is dig into the data. What is the data telling us at any particular time. So as we think about data, and I mentioned earlier, sometimes quantitative work becomes just numbers on a spreadsheet, and there's value to that at times because you can extract out your own biases when you're just looking at data. And at the time, we were looking at, well, valuations were high, and valuations subsequent to that and subsequent to what happened in March of this year have kind of gone back to their all-time highs. But when we looked at, PE multiples, and we're big fans of the Shiller CAPE ratio, price over kind of trailing 10-year earnings or 10-year real earnings, because it gives you a business cycle free look at equities. And we also look at very long histories of data. So, when we look at data and try to say, well, if you're a value investor, value kind of implies that you have some idea of what the fair value of something is. It's hard to say something is overvalued or undervalued if you don't have an idea of what fair value is. And so we look at very long histories of data, decades and as much as we can get, but decades and decades of data to try to figure out what is the fair value of an asset. And then once you figure that out, then you say, well, okay, have there been any structural changes? The U.S. economy is very different than it was in the late 1800s. What does that mean for, long-term average of, say, a PE multiple or a spread or a treasury yield? And then we start to overlay those sorts of things on, and that's usually what leads us to, to most of our things that we come up with as to how we want to, position a portfolio or make a trade.
Yeah, I'm glad you mentioned Shiller CAPE. I've wanted to ask you something. Some people adjust this for margins because we from time to time the past few years we've heard this argument that corporate profit margins are very high compared to historical norms, and so one might adjust CAPE for margins and wind up with something that people call MAPE. What do you think of that idea? Is that necessary?
Well, I would say, if you just look at the simple, Shiller CAPE ratio and, the one that Professor Shiller publishes on his website, and you say, well, let me look at the most recent value and, compare it to its long-term average. And the long-term average going back to, Professor Shiller publishes data back to the 1870s. If you just take an average of that, it's about 16 or 17. Well, we haven't really hit a value of 16 or 17 in a long, long time. In fact, even during the financial crisis, we dipped below that average for only a few months. So I understand the reasons that folks want to make different changes. Margins is one that you talked about. I know others that just say they strip out the global financial crisis earnings because those were artificially low. Other people do Windsor'izations and things like that. We do just more of a simple thing, which is, look, let's just take a, exponentially weighted moving average. So instead of arbitrarily, change this amount, change that amount. And if you do, if you change the margin, how do you change it? What's your new margin? Is it just a more recent margin? Is that going to be descriptive in the future? So there's nothing wrong with those adjustments, but they also introduce their own, call it moving parts. And now you have something that's simple that has a lot of moving parts. So what we do is something very simple and just say, let's just downweight really long ago history. We still think it's meaningful. We think that all data is meaningful in some ways. It's just how much weight do you give it? So we give a lot more weight to, say, the last, 40 years than we do to, the early 20th century. And that gives you a pretty nice view of, it's a slow moving signal, but it allows you to say, how is the overall, equity markets adapting over time?
I see. I was going to ask you about that, about, 100 years ago data versus more recent.
That's a debate that everyone has.
Yeah. Yeah. It's a good question, isn't it? I mean, how relevant are, the railroad stocks and industrial companies and steel companies and things that dominated the data, decades and decades ago versus, whatever we have dominating the data today. It's a reasonable question, I suppose.
Absolutely. No, it absolutely is. And it's every data series that we look at, and I've said a couple times, we like as much data as we can get, but you do have to be careful. Even the quality of the historical data. A lot of this data is, it might have been captured in a book somewhere that somebody's transcribed and put online. You can even get, equity market prices for some markets back to the 1600s. I don't know the really quality of that data or what they were trading, in London in 1620. So, you need to be careful. And what we do, and as I mentioned earlier, is we usually try to do some sort of weighting scheme instead of just having an equally weighted average, which says, look, the data last year is just as relevant as the data in 1855. Say, look, the more recent data in most cases is going to be more relevant. Now, that doesn't mean we want to, again, just throw out old data. It doesn't mean that we want to just completely put all the weight on the last, year, 5 years, 10 years. We still want a few decades, where we can get it. And, the post-war period tends to be something that a lot of people use. And we definitely sort of overweight that data versus, what you would have seen, say, pre-World War II.
Gotcha. Another thing that strikes me as interesting about using decades and decades of data, you were saying that this is part of your process for establishing the fair value of an asset. And that's interesting to me because, you may not be like Mr. I believe deeply in the efficient market hypothesis or anything, but you are trusting the market to value the asset over the long term, are you not?
Yeah, so our theory is that the fair value is somewhere in the middle there, and the market will trade around that fair value. We'll rarely ever stop on it. It'll things will get bid up past fair value, they'll get sold off past fair value, but the average of that. So if you look back historically and say, the Schiller Cape, I think, is a good example. Look at what that series shows you and say, well, look, at sometimes we were expensive, at sometimes we were cheap. Somewhere in the middle there is the fair value or a decent representation of the fair value of, an asset. And for a lot of what we're doing, or the way we think about it is we're not trying to, necessarily pinpoint the exact value of any asset. What we're saying is, look, compared to where we are today, directionally, are we above or below a range? So we're never going to say, the perfect fair value, PE multiple for the US is, 18.463. We're going to say, well, it's somewhere around, and I'm just making this up and saying, let's just call it between, 16 and 20 is, and if we're trading at 25, well, we pretty strongly feel like we're overvalued. We might put on a trade there to sell or underweight in that case. And as we get closer to 20, we'll back that off. And when we get to 20, we might still be a little bit, underweight, but it's going to be a lot less than we were, when we were at 25. And when we start to get to the middle of that range, we're probably at neutral weight on that asset.
I see. And so now we're into the topic of averages. And we all know it happens, to the 6-foot man who drowned in the river of average depth of 3 feet, right?
Yep.
So, and I also noticed, though, you guys, of course, you're all over that topic. And in a paper that you wrote, little piece 3 years ago, I think it was, you said something like future return equals expected return, plus unexpected shocks. So I assume that there's some kind of strategizing or tactics or something around preparing portfolios for unexpected shocks if you're basing these valuations and trades on averages. Yes?
Yeah, that's exactly right. So we'll look at, say, an average and say, well, that's a strategic fair value. And over, a number of years, and a lot of times we talk about 10 years and say, well, over the next decade, an asset, if it's overvalued or undervalued, should move towards that average, and that's a strategic position. But a lot of things happen in shorter time frames. So the business cycle, for instance, we might be overweight, or we might think that, equities are overvalued. But if the economy is roaring along and, GDP growth is high, well, there's a good chance that equities are going to continue to outperform. And so we're not going to, go in and say, well, hey, the average is the average says we're overvalued. We better sell now. We're going to say, look, we still think we're overvalued, but that doesn't mean that we can't, actually buy some assets. Now, we'll be aware of the fact that, look, at some point, we think that there will be a correction. So we might, put on a trade and actually buy something that looks overvalued versus its average. But we'll have call it a stoplight on that, and we'll be very keen to the fact that that's a position that we're trading for a short-term purpose. And again, it usually, well, we have a number of different signals that look at a lot of different things, but for the purpose of this example, it might be, if it's a business cycle reason, then we're going to be monitoring what's the business cycle telling us. What is growth doing? Growth this year, GDP growth this year is a little bit all over the map, obviously, because we had a huge, down correction followed by a huge up correction. So, net, we kind of have to smooth that out a little bit. Otherwise, you get some crazy whipsaws.
Right. Okay. So let's try to get rubber on the road a little bit here, Jim. If I go to the how to invest page on researchaffiliates.com, there's a lot of options here. Let's see, I've got 4 asset classes: equity, fixed income, multi-asset, and alternatives. I've got 3 strategy types: smart beta, asset allocation, and active strategies. And I've got 5 categories of market exposure: global, developed, Europe, Asia Pacific, US, and emerging markets. It seems like a lot to juggle. I mean, is there anything like remotely like a typical client portfolio for you? Is there a core of some kind?
Yeah, so it's really interesting that you mentioned that. One of the things that we're working on now, which we'll actually release, probably not supposed to talk about it, but just between you, me, and anyone listening to this, we are working on a set of model portfolios that we'll release to answer the exact question you just asked, which is, hey, I come to this how to invest page and there's just too many options, and I usually just go away because too many options are overwhelming, and I just don't know what to do. So we're actually building out a set of model portfolios for different types of investors. You can think about it, conservative risk investor, an aggressive investor, high tracking error, low tracking error. And so what does that look like from a multi-asset perspective? And then how does that actually drill down to these actual products? And how do you fill in, your different buckets in your asset allocation with our particular, products here? So that's coming, hopefully in the next, call it, couple of months, probably early part of 2021. But that'll help answer that question.
Yeah, it's funny. We've been through this exercise at Stansberry, because we found ourselves making dozens of products, and we were making, well over 100 recommendations or so in a given year, maybe more, maybe 200, I don't know. And so we wound up with, I think we started with 2 or 3 of these model portfolios, and I think we're up to 5 now. So they're going to, how many of those are we going to have in 10 years? I'm just warning you ahead of time. This thing could get out of control too.
Yeah, that's it's funny you say that. We've been thinking about that. How do we make sure we don't turn into model portfolio proliferation, and then you've basically just replaced one problem with another problem? We have an interesting, and you talked a little bit about the firm earlier, we have an interesting business model in that we talk about ourselves as an asset manager that doesn't manage any assets, because really we partner with other asset managers, either in a sub-advisor or role, or we license our IP. And so for every category, and you can see it on our How to Invest page, we have multiple products from different different partners that we have. And so we don't want to promote one partner over another. We love all of our partners. And so that gives us an interesting challenge too, to try to narrow down the choice for end investors, but also show them that, look, there's some choices is okay. And so, but that's what keeps this job interesting, and that's what keeps us thinking about new and exciting ways to help investors.
Yeah, and everybody ultimately has that issue. It's the interplay, isn't it, between what you think is the right thing to do and then what your client wants, right? So there's always that interplay. And I noticed you got some pretty big clients: Invesco, BlackRock, PIMCO, Schwab. And so when they express their desires, it must get intimidating at times, no?
Um, it could. The way I always handle it, and I think everyone has their own way, but I try to abstract away from our partners and just think about the end investor. And it's a little bit, standing on a soapbox, or a little bit, trite, but it's, what do you want your grandmother putting her money in? And if the product meets those needs, then that's enough. And, to the extent that, our partners want something else, we can talk about that. And, it's easy to get caught up in well, if, we want something and a partner wants something, those might be at odds many times. And I would say more often than not, what ends up happening is that those ideas actually feed on each other and actually produce a better product. So, it's not always, adversarial. It's at times, we might have disagreements on things, but, we're lucky maybe in that our partners, think about the world the way we do. And that is about, what helps investors, because at the end of the day, if you're not trying to help investors, or, there's just a veil of trying to help investors, but you're really trying to do something else, people in this industry figure it out pretty quickly. There's just too much choice. And so we try to be very clear on, here's our product. This is the way we develop it. It meets A, B, and C goals. And during such and such a time, it's going to underperform, as every product, underperforms. I always laugh when when I interview candidates out of school, and every resume has what did you do in school? Well, I developed the next, Fama French 3-factor model, and my strategy has a Sharpe ratio of 5, and it outperforms in every period. And it's just, okay, that's nice, but here's why, here are the problems with that strategy. And the main one obviously is that it's probably just data mined. You fit something to the historical data that's not going to work in the future. And that's definitely not what we're about, and what our partners are about.
So on this, I'm going to try to keep the rubber on the road here. On this, how to invest page, it looks like all the products that I'm looking at appear to have a ticker symbol. And I'm wondering, is there anything else, for example, when you guys talk about alternatives, is it always financial assets sort of packaged into a fund that can be traded, with a ticker symbol? Or are there, do you actually buy hard assets, land or real estate, or any of those traditional hard asset type alternatives?
All of our products are financial assets. And so you see the tickers on the how to invest page of the funds that are all, the majority of these are equity portfolios that, again, we license our IP to, Invesco and Schwab and the others. And they're actually the ones who are, building and marketing, the products with the tickers you see here. The products that I work on in particular, in asset allocation space, again, are all financial assets, and the majority of them are funds of funds. So we're out there purchasing, mutual funds or ETFs across the various asset classes and putting those together in a portfolio. And so we spend a lot of time thinking about the, interactions, correlations between those asset classes, which, under what scenarios do they do well? Under what scenarios don't they do well? What does value, again, how to think about valuations in different asset classes? How does that change when you think about US versus other countries? We talked about data earlier and having a lot of data. When you go to certain emerging markets, you might be lucky to get, 10 years of data or 20 years of data. And so how do we think about that? And we have to make adjustments for the fact that, if you take an average, if you say the fair value of something in the last 50 years is X, and some other asset only has 20 years of data, you can't just say, well, I'll just look at the average over that 20 years and compare them. You end up with a very biased representation. So we spend a lot of time in my group thinking about that.
Interesting. Okay. Hey, I'm just curious, Jim, does Research Affiliates, do any of your products contain any representation of cryptocurrency, Bitcoin or anything?
No, we don't. We've talked about it in passing, and I no plans that I know of to go down that route. I think cryptocurrency is a really interesting area, and there are folks out there who despise it as an asset class, if we can even call it an asset class. Again, I think cryptocurrencies and regular currencies, fiat currencies, are very similar. There are some differences, but they are very similar. And so I tend to personally, although I don't own any cryptocurrencies, I do think it's an interesting area that's going to change fundamentally how we think about currencies and banking and how central banks act and things like that. So I think over the next decade, cryptocurrencies will just be a mainstream thing.
Yeah, it's getting there quick, isn't it? Okay, so we've been talking for a little while here. It's gone by really fast. If I always ask the same final question of all my guests, and I'm, among other things, just curious how they handle it. So if you could leave our listeners with just one thought today, and it can be about anything, what would that thought be here in the latter part of 2020?
Oh, that's a great question. And when you said it can be about anything, that just opens the door to so many things. I will give you two. I'll give you one, and then I'll give you another one that might be more tongue in cheek. But I will. I think 2020 has been a hard year for everyone. Although markets are way up this year, or at least have made back a lot of their losses from March. The stock markets themselves have done okay, but it's been a hard year. So my thought is, I think it might get, things might get harder before they get easier, but they are going to get easier. And so as we're all working from home and, maybe devoid of, human contact and the normal things that we do, and our patterns and our habits have to change, things will go back to normal eventually. So I hope everyone out there who's listening to this is safe and healthy, and can keep their eyes forward, and we'll get there eventually. Now, my second thought, because you said it can be about anything, I happen to be a very big Cleveland sports fan. I grew up in Ohio, and so I'm hoping for a Browns Super Bowl in the next year or two. Well, probably not this year, but maybe in the next 3 to 5 years. Let's put it that way. So that's, I guess, my final thought.
You going to bet real money on that, Jim?
You know what? As a fan, I'm probably fanatical enough to do it. But that's what fandom is.
There you go. Yep. Hey, skin in the game. I can appreciate that. This has been a lot of fun. I feel like as I just sort of kept the Research Affiliates website in front of me as we're talking, there's so much there. I feel like we could have you back 10 more times and not cover half of it. So maybe in 6 or 12 months, we'll invite you back, and hopefully things will look a little better, in mid to late 2021 than they do right now. But we'd love to have you back.
I hope so. I would love to. Totally enjoyed it. It was a lot of fun. Thank you.
All right. Well, thank you, Jim. I guess it's bye-bye for now.
All righty. Take care.
That was really cool. But I promise you, talking with Jim for one interview, we've like scratched the surface of what they've got going on at Research Affiliates. I go to that website all the time, researchaffiliates.com, because like I said, there's, you click on the Insights tab on Research Affiliates, and it says publications, journal papers, and a bunch of other stuff. And and then if you just click on publications, it says there's 251 articles, right? So there's a lot there. You're not going to go through this stuff in a day or a weekend or whatever. There's probably something on like every topic you could ever want. And they tell you there's a list of authors, so you can click on Jim's name and get all the papers he's written, or you can click on Rob Arnott's name or any of the other folks at Research Affiliates. It's a cool website, and it'll teach you a lot about some really technical stuff. There's some technical language in this stuff, but I think, just listening to Jim talk, you get the impression that these people know how to put it in plain English, and I think they do a pretty good job of that in their written work too. Lots of fun. That was cool. Let's take a look at the mailbag. You know how I'm always saying that I don't want this show to be too political? Because after all, it's a finance show, and some politics is appropriate, but it can get too much real quick, right? Well, maybe you're interested in politics. Maybe you're interested in American and global economics and politics. If so, you're probably going to be pretty excited to know that Trish Regan, the famous finance and political journalist, is now part of the Stansberry team. And Trish Regan has a brand new podcast. It's called American Consequences. You can find it anywhere that you listen to podcasts, iTunes, Google Play, anywhere. Or you can just go straight to AmericanConsequencesPodcast.com. And she's already had some huge names on the show, like billionaire businessman John Catsimatidis and former U.S. Senate candidate Tom Del Beccaro. So check it out. It's available anywhere you listen to podcasts, or just go to AmericanConsequencespodcast.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read every word of every email you send me, even a couple pretty long ones this week, I got to tell you, and I respond to as many as possible. All right, this week, some people wrote in about election fraud. I got Bob D. and Vaughn M. here. Vaughn M. says he included a link to a story, and then he says, read that and then imagine a government successfully reconciling who mailed in, who voted in real time, and who didn't vote at all. Seems so obviously flawed that it's hard to suspend disbelief. Vaughn M. Bob D. says, you have to know that there are many things wrong with this election. Simple me, Bob says of himself, simple me can see the obvious criminal vote fraud going on. This means that the deep swamp and the mail-in votes are stealing the election. Trump is not going to stand for that. The economy and your financial advice are in dreamland, which I think is a nightmare. Cash, Bitcoin, and precious metals are the only sure assets. A real revolution possible? Question mark, question mark, question mark. Bob D. So, Bob, I have to take issue with you here. You're saying my financial advice is in dreamland? Are you kidding me? I'm the guy who has been bearish, admittedly wrong, for 3 years. Since you can read my newsletter, Extreme Value, starting in May of 2017. I mean, and between then and now, I did a whole issue or two, if I'm not mistaken. I think definitely one on holding cash. And I've recommended short-term treasuries, cash, Bitcoin, and gold and silver for as long as I can remember. I'm the cash, Bitcoin, precious metals guy, for Christ's sake here. I mean, I'm the cash, Bitcoin, precious metals guy. And you're telling me that my financial advice is in dreamland? And of course, I've said, don't sell your stocks and bonds. And we're going to get to that later with another question. But you seem really convinced that there's election fraud going on. Maybe. I don't know. I don't know about these things. We'll find out. Dave P. writes in next, and he says, I love listening to your podcast. You are one of the only guys I listen to that has the stones to say what you think. Yeah, Dave. He continues, as I was listening to your podcast on 11/5, 2 days after Election Day, without a new president or a conclusion on the Senate, I felt your pain being long major market puts as the market rampages on the expectation of a Biden win with a red Senate. I just hope you were able to close those positions quickly. I believe a reckoning is coming, as I have been incorrectly short for a while until last week. I just don't know when. I'll get short again when it appears appropriate. Can't wait to hear your thoughts and find out how you handled your shorts next week. I just hope we have firm results. As you, I really don't care who wins as long as I know how to manage my portfolio accordingly. Also, great call on Bitcoin as it roared through 15,000. I have been mining since 2017 and buying since May of this year. Keep up the good work, Dave P. Hey, Dave, good on you for mining Bitcoin since 2017 and buying since May of this year. You've done well with that. As far as my shorts, don't worry. I have some longer dated puts still on, but all my put positions are tiny, right? Because I go out of the money. I'm ready to lose every penny of that position. And so it's like sleep easy, tiny little expense. Don't worry about it. Don't worry about me, Dave. But I appreciate you. I appreciate the concern. Next is Doug M. Doug M says, hi, Dan. Really enjoy the show. In the last episode, you said you weren't a big fan of the broad-based commodity ETFs. I'm going to stop you right there, Doug. Just to clarify for everybody, the commodity ETFs based on usually like the first 2 months of rolling, a rolling average of the first 2 months of futures contracts. I don't like that. That roll, it creates what they call a negative roll yield, and it just eats up capital. He continues, given that, how would you suggest individual investors gain access to commodities as part of an asset allocation strategy? I'm thinking of commodities other than precious metals that really can't be held physically, things like agricultural, industrial metals, or energy commodities. Are they not worth holding, or is there a suitable way to get a basket of them for diversification purposes? Thanks, Doug M. So, Doug M., I've talked about a company that I've been covering in my newsletter since 2009, and I have spoken about it in public. It's one of the ones I do speak about in public. There are several that I don't because people pay a lot of money for extreme value, okay? So, but since this one is, an 11-year-old recommendation, I can talk about it. It's called Altius Minerals, and they've got a portfolio of diversified royalties that is unlike anything you'll find in any other company. I don't think there's anything like it. There's copper in there, there's iron ore in there, there's a really fantastic, the crown jewel is the potash royalties. You mentioned agricultural. And so it's base metals pretty much and potash. And then you also get now renewable energy, which, the renewable energy assets, they just produce and produce and produce. They don't have mine lives that run out in 10 years. They don't produce forever, right? But they'll produce for a long time. So that's my response to that. Get yourself a portfolio of royalties in those things if you can. Good question. Great question, in fact. Lastly this week, Taylor S. writes in and says, hey, Mr. Ferris, new listener here. Also, rather new to investing. I would like your thoughts on a few things if possible. I'm going to answer 2 of your 3 questions, Taylor, because I don't really feel, you asked about Fed coin versus Bitcoin. I don't really feel like I know enough about Fed coin yet on my own. I could ask somebody else about it, but I need to look into it myself. And frankly, I hadn't heard a word about it or thought a thing about it until I looked at your question. So, but your other 2 questions are really good. Number 1, you say, you suggest buying assets like stocks, bonds, real estate, gold, and Bitcoin to hedge against a falling/worthless dollar. Wouldn't companies listed on the stock exchange be dramatically affected by a falling dollar? So why would holding their stock be beneficial? Taylor, if you listen to what I said in the past, I recommend true diversification because I don't know what's going to happen in the future. Yes, a falling dollar should benefit the real estate, the gold, the Bitcoin, and not the financial assets, not the stocks and bonds. Inflation is bad for business. And, if you look at the stock market, went sort of sideways and traded at really cheap multiples in the 70s because of inflation. So just wanted to clarify that. I'm saying don't sell your stocks and bonds because you want to stake in the unstoppable ascent of man, the unstoppable innovation and improvements to our standard of living, right? People wake up every day trying to make the world a better place. They wake up every day trying to service with, some service or business or product that they're making. And you want to maintain a stake in that. So you keep your stocks and your bonds. But you also understand that you don't know the future. Fiat currencies always depreciate in value over the long term. So you want to have your gold and silver and Bitcoin, and maybe, I mentioned real estate as something that you might know something about, but that's in the category of assets that you have some particular expertise in. And I mentioned a wide variety of sort of collectible type things from, Ferraris, collectible coins, whiskey in casks in a warehouse in Scotland, wine, some people collect that. Whatever it is, there are ways to store value. I also mentioned vintage Gibson and Fender guitars, right? Just ways to preserve value, get it outside the US dollar. Your second question is the 10% adoption curve that Stansberry talks about when it comes to Bitcoin. Is that worldwide or just within the US? I don't know what that is, and I don't need to know what it is, but it sounds like somebody in Stansberry said maybe, if 10% of the currency market adopts Bitcoin, 10% of the businesses, I don't even know. But it's just a way of measuring how valuable Bitcoin could be if a whole lot more people are interested in it. And for example, the current market cap of Bitcoin, it's around 260 or 270, something like 260 or 270 billion. But if it gets widespread adoption as a currency in a world where trillions and trillions and trillions of dollars of currency, businesses transacted every day. And there are tens and tens of trillions of dollars and yen and euro out there. So I don't know if they're saying maybe the Bitcoin could replace 10% of that. But, if it replaces if the market cap goes to 5 trillion, let's say, of all the Bitcoin, I mean, that's like a 15 or 20 bagger right there from current prices. And if it goes to, 10 trillion, 20, whatever, that's the way that a lot of people have thought about this. Murray Stahl at Horizon Kinetics, or maybe it was his colleague, I forget which one of those guys, they did a little bit where they looked at global, I think it was like the M2 measure of money supply, and they said, this thing, it could be like a 400 bagger if Bitcoin replaces a meaningful portion of this money supply. So that's the idea. I don't know specifically. It doesn't even matter to me what this 10% adoption curve means. But in my opinion, what I just said is the way you need to think about Bitcoin. It is the hardest currency in existence so far. It's very young, right? It's 11 years old, but it's already managed rather perfectly, right? There are 18.5 million Bitcoins. Between now and 2140, there will be no more than 21 million Bitcoins. And that's really cool. That right away makes it the hardest currency in existence because just this year, the Federal Reserve has printed 3 trillion new US dollars, just like that, if you just look at their total assets. So, yeah, you should think about this adoption curve idea. You should think about a currency like Bitcoin that's not going to be inflated away, gaining widespread acceptance. That's the point of it. And it's a great question, Taylor. It's a great question. It's exactly how you should be thinking about Bitcoin. Good questions. Very good questions. All right. That's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. If you want to hear more from Stansberry Research, check out AmericanConsequences.com/podcast. That's Trish Regan's new podcast. Do me a favor, subscribe to our show and hers on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow these shows with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. Also follow us on Twitter, where our handle is @investor_hour. If you have a guest you'd like me to interview, drop me a note at feedback@investorhour.com. Till next week, I'm Dan Ferris. Thank you for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.